Hello friends, welcome to Invest India. So in this particular video, we'll be talking about a very important parameter that every retail investor must look at before investing in a particular company. That is the operating margins of the company or even the direction of operating margins of the company. So generally what happens is whenever the financial results of a company comes every quarter, each quarter a retail investor just looks at two things. First is the profit or growth of the company, and second is the revenue growth of the company. Based on these two parameters only, a retail investor decides to invest or not to invest in a particular company. What more so importantly, a retail investor must definitely analyze the operating margins of the company, the direction of the operating margins of the company, or even if he is able to predict the future operating margins of the company, so he must analyze that as well. So why this is important? Because whether the company has a competitive advantage or any pricing power in the particular industry the company operates in can be understood by analyzing the margins of the company over a period of time. So to understand this better, let's discuss with few scenarios along with examples. Scenario 1, in most cases, more stable the margins of the company, more the company has pricing power and competitive advantage in the industry. These type of businesses are generally moated businesses, and let's understand with a better way with an example. So we will take an example of a company, namely PI Industries. So we are looking at the profit and loss statement of PI Industries of last 10-12 years, and basically what we can understand by looking at it is in last 7 to 8 years, the company's profit margins, the operating profit margins have been pretty stable at 20 to 22%. Like from the year March 15 to March this particular year, the margins have been pretty stable. So this just tells you how much pricing power the company has, because we had a rampant inflation in last 1 or 2 years, and still the company is able to maintain its margins. This just shows the company has the pricing power. The company is able to pass on whatever increase in input cost it has. And more so, even in the last quarter, the margins of the company expanded to 26%. And when the management was asked what was the reason for the same, so the management said that it happened because of the operating leverage and change in product mix. So the company is able to increase its margins further from here. So just understand how much robust the business model of the company is. So in the business model, business in which company operates has a very high entry barriers. So that's our first scenario. Scenario 2. So the companies which have very high fluctuating operating margins is basically a commoditized business. So in this case, we will take an example of a company by the name of Tata Steel. So this is the P&L statement of Tata Steel for last 10 to 12 years. Here you can see in the last 10 to 12 years how fluctuating the margins of the company have been. So in year 2011 it was around 11%, then it dropped to 9%, then to 3%, and then again back to 11%. And you can see in the year 2016 it was negative 1%. So this was never the case with PI Industries. In PI Industries profit and loss, we always had positive margins. So this particular example is ideally an example of commoditized business in which margins are fluctuating a lot, because the final product which company is manufacturing, that is steel, the company does not have any pricing power over it, because the competitors are easily able to provide that particular commodity, and the determination of price of steel in this particular industry is based on the supply demand situation. So this is an example of a commoditized business. Scenario 3. So ideally, an even better company would be a company whose management is employing a business strategy which is to go up the value chain. So what do you mean by going up the value chain? Basically, when a company enters into new product lines or even a new industry where the margins of the company is higher than the existing business operations of the company, in that particular case, the company is moving up the value chain. So what is the difference between this scenario and the scenario 2? So here what will happen is when the company is entering into new business segments where the margins are higher, the margins of the company will do increase, but this increase will be sustainable. In scenario 2, what was happening is the margins were very volatile. There was increase in margins definitely happening, but that was because of the demand supply situation, because of the change in prices. That increase was not sustainable. So, but in this scenario 3, the increase will be sustainable. So, this is even a better business model than scenario 1. And these type of businesses are called well managed companies just because the management is constantly looking for creating additional shareholder value by working really hard and investing into newer industries, so that the margins of the company can increase and the market can even give a higher PE multiple for these type of companies because the margins is constantly increasing. So in this particular scenario, we'll be taking an example of a company named Polycab India Limited.
So as you can see in the profit and loss statement of Polycab India, that in last 8 years the company's margins have been continuously rising over a period of time. So as you can see in year 2014 and 2015, the margins were around 8 to 9% for the company, and right now the margins have risen to 12%. So this has happened because the company is continuously improving its product mix, continuously upgrading its value chains, and entering into higher margin products, which has led to this considerable increase in margins. And the good thing about this increase in margins is this increase is sustainable, and it will not come down as it happened in the case of JSW Steel. If you like these type of companies, as management here is continuously looking to improve the business model of the company, making it more robust, and thus enabling faster growth in shareholder value. And more importantly, this growth in margins is sustainable.
So this type of business models are pretty great business models, and one should definitely, if the management is pretty capable of executing such a thing, one should definitely look at these particular type of companies and definitely invest in these companies, because if the margins continuously rise and the revenues obviously rising, the profits expand rapidly. So these are very well managed companies. Scenario 4. So in this particular scenario, we'll be discussing how margins can disrupt the profitability and returns of even a fast growing company. So here we have taken an example of a company here which is a fast growing company, and we have a financials for the company for last 7 years, and it's a fast growing company whose revenue is growing at a pretty rapid pace, around 25 to 30% CAGR. And here we also will be discussing what is an upcycle and down cycle. So let's analyze bit by bit each line item of the company. So first we will go with revenue. You can see the revenue of the company, which we have already said is growing at a pretty rapid pace, around 25 to 30%. So see here you can see it has been growing it in each year at a very rapid clip. First it was growing at 30%, then at 25%. So revenue eventually quadrupled in 7 years time period. And as you can see, the margin of the company started with 10%, then it increased to 15%, and then it increased to 18%, and then increased to 20%. So this is a commoditized business, and you can see the margins have peaked in year 2020, right? They have peaked in year 2020, and after that the margins have been on a declining stage, right? So what is happening is, look at the EBITDA of the company. It has grown to 20 CR in year 2020. It is at 220 CR, and in next 3 to 4 years, from 2020 to 2023, look at the EBITDA of the company, the operating profit of the company. It has actually declined by 12%. When the revenue of the company has doubled, the profits of the company has actually declined by 12% in the same period. And this will definitely affect the returns of the company. And this has happened because the margins of the company have declined rapidly after that. This is a commoditized business, and the margins went back to its normal margins of 9 to 10%. And that's why this thing happened in this particular company. So you can see how margins can meaningfully impact the profitability of the company, and definitely a lot of investors lose money if they will remain investing in this particular company up till last year. So the purpose of making this video is to make every retail investor understand what is the importance of analyzing the margins of the company, because every retail investor must invest in a portfolio of 10 to 15 stocks, and all the stocks will not lie in scenario 1 or scenario 3. Some will lie in scenario 2 as well, which is a commoditized business. So while investing in a commoditized business, investor should have a knowledge about up cycles and down cycles. If he doesn't understand up cycles and down cycles, he will definitely lose a lot of money, or there will be some time bound correction in which the stock will remain stagnant, and over a period of time, the investor will not make any return. So the investor, if he understands the down cycle and up cycle in a better manner, then the investor, by analyzing margins, can make much better returns. That's pretty much from our side for this particular topic. Thank you so much for watching. Do follow us for more such videos.